It's a simple concept, but not enough business owners understand the power of that. Instead of trying to go get 10 more customers, I can just save taxes. I don't have to work any harder and I make more money. Work less hard and make more money by just doing a few tweaks and things by
That's like really good actionable advice for everyone, including including myself.
Tyler is not your typical numbers guy. He's a financial strategist who has helped countless entrepreneurs maximize their profits while keeping Uncle Sam at bay.
As a trusted advisor to Tony Robbins, Tyler brings a wealth of knowledge and a unique perspective on business growth and tax strategy.
I see a lot of businesses would like to put their spouses on payroll.
it can be a smart tax move. There's two key scenarios when it makes sense to put your spouse on payroll. And the scenario that is the auditor sits across the table from you and asks you to explain this deduction. You have to be able to explain it to them with a straight face and fully legitimate that this is the business reason for doing this, because you can't do something just for tax purposes. But the problem is,
I have a 1-year-old daughter, and I was always thinking about take that money and set them up with a Roth IRA. Although the real question, Tyler, here is what percent of kids actually will not touch that till they're allowed to at whatever it is, 59 and a half.
well, I mean, you don't have to tell them about it.
The Avenue of the Strongest is a podcast dedicated to exploring the lives and experiences of the most inspiring individuals from around the world. Each episode features interviews with fascinating guests who share their insights and wisdom on a variety of topics, including education, impact, motivation, health, and learning. Here are your hosts, Anayet Chowdhury and Vlad Suleiman.
Tyler, welcome to the show.
Thanks for having me.
Yeah, I want to start off the conversation first. This is our second time, if Vlad, is that correct? When we get to talk about accounting and finances. So
Yeah, second time.
and this is probably one of my favorite topics to talk about because obviously in the United States, financial literacy has always been low. And I think this is like one of the most important skills. So I kind of want to start our conversation first. I'd love to ask you, what are one or two things that you really wish everyone knew about either financial literacy or accounting? I'm just keeping it broad here, but that everybody needs to know.
Yeah. Specifically on taxes, because that's kind of where I spend the most of my time. And I think it's an area that everyone comes to with so much confusion. I think two things I would say that come to mind is one on the employee side and another on the business owner side. So on the business owner side, I think the thing that, and this is what I try to get out in my message that I share daily, is that on the business owner side, there's so much you can do to actually lower your taxes rather than just accepting that it is what it is. But if you don't plan and meet with your accountant or your tax advisor throughout the year, and particularly before the end of the year to do what's called tax planning, then you're leaving a ton of money on the table. And way too many business owners are too busy running their business or trying to drum up new sales, and they don't take the time to actually look at their tax bill. And when I was doing a webinar with Damon John from Shark Tank, actually, he said something that I thought was really profound. He said, "What I was always blown away when I first started, operating FUBU and and I wasn't thinking about taxes. Then I started to think about it. I realized that instead of trying to go get 10 more customers, I can just save taxes. I don't have to work any harder and I make more money. And so like you can actually work less hard and make more money by just doing a few tweaks and things by meeting before the end of the year and doing tax planning. So that's one thing that it's a simple concept, but not enough business owners understand the power of that. The
Mm,
other side, the flip side on the employee side, I always said I think it would be, we just had the election, and politics are a little hotter than they are, normally right now, of course. But I think that even a good economy, country, its citizens, etc., comes out of an engaged country, right? And I think more people would be engaged with what's happening with their tax dollars if they really understood what was being withheld from their paycheck. Because
mhm,
most
mhm.
people they just look at their net check. They never look at their pay stub and how much taxes are actually being taken out. And I always thought it'd be really fascinating if you, instead of just having withhold taxes withheld and you just get the amount of money in your checking account each paycheck, if instead they gave you everything, but they automatically divided your take home into a checking account and your withholdings into a savings account that you can't touch, but you can see when you log in, and then it gets zapped and drained to zero on tax day, I think people would be a lot more interested in where their tax dollars are going. So that's always something that's been really interesting to me on the employee side is people just are not educated with how much is actually being withheld from their paycheck because they just care about their net check.
Hmm. That's but can employees do anything about that? Any of the deductions that are been taken out, or it's if you're a W-2 employee, if you're no matter what you're getting your federal taxes, your state level taxes, your city taxes, Social Security, and all that kind of stuff.
Yeah, so you can impact that number. You have to have some sort of taxes withheld. But when you fill out your what's called your W-4 as an employee, you can change your withholdings. And a lot of people like to set up their withholdings so they get a big refund at the end of the year. Well,
Right.
that refund actually isn't always a good thing. It feels good because it's a nice forced savings account and you get a big chunk of cash all at once, but it actually means you gave the government an interest-free loan to play with your
Right.
money all year long. And then they give it back
Mm.
to you versus maybe if you set up your withholdings so that you have a bigger take-home check, as long as you know what you're going to owe at the end of the year and can plan for it, you can have access to those funds throughout the year and invest them yourself instead of letting the IRS invest them however they feel like they
That's
want
such a
to.
good point that you made, and it's so funny because uh, I I think that I'm pretty financially literate, running many companies, but it's my wife. She works a job where she's a W-2 employee, and for the withholdings, it's the same exact approach that she asked me in the beginning of the year, hey, what should I put over here? I just say no, just put zero or whatever. So they take away the most amount of money, and then if they owe you something, but like even me, and I'm just realizing because you're right. I mean, at the very least, I can have that extra money sitting in Treasury bonds, yielding whatever it's 4.83, almost 5%, whatever the case is, at minimum, as opposed to giving it away. So I think that's like really good actionable advice for everyone, including including myself. Because I mean, listen, well, at the end of the day, listen, it's not going to translate into tens of thousands of dollars earned in interest, right? Unless you're making millions
I
of
mean, if you're
dollars.
making very, very good W-2 money for
Exactly,
sure, but
exactly.
but
But
yeah, but every little bit counts, and it's also a lot of people say, well, I got to pay the IRS and I have withholdings, or you can pay, put money into retirement. Well, if you and I'm not saying get behind on your taxes, but
mhm,
taxes come due every year. Retirement, you should be investing in every year. You can always catch up your payments to the tax man. You can never catch up the power of
mm,
compound interest over time. And
mm,
so between the two, it's actually better to pay yourself first than it is to pay the IRS first,
mm,
because so that you can ultimately, invest that and have the power of compound interest rather than just kind of having life happen to you.
mm,
So yeah, and even if it's a few hundred, if you adjust your take home by $300 or $400 a month extra, and you know that you have to set that aside, like you said, maybe you put it in a T-bill that earns 5%, that still could be a few $100s a year that you would get that you wouldn't otherwise get rather than letting the government make that money.
yeah,
But
yeah,
on
and
this
I
additional
and
on this additional money that you will earn, this $300-400 a year, you'll still pay taxes on this amount as well, right?
well, of course, but if it's a T bill, what is it?
Yeah, unless you put that money into a retirement account, a tax advantage retirement account like a Roth IRA or a 401k, then that would be extra money. You'd take a deduction. You still owe some tax on the earnings, but uh, but if the earnings are inside of a retirement vehicle, then you wouldn't pay tax until you pulled it out in retirement.
Yeah.
This podcast is sponsored by Argo Prep, an award-winning educational publisher serving over 1 million students nationwide. If you're a kindergarten to 8th grade teacher or principal, be sure to check out our supplementary workbooks to get your students ready for standardized state testing. We cover all subjects from kindergarten to 8th grade. Use the coupon code AVENUE for a 25% discount off of all purchase orders. Visit us today at argoprep.com/store. Yeah, I think that I think a bigger point here that I want to emphasize also is that this is just great financial discipline. Even if it's translates to literally, I don't know, like $10 in interest earned in the whole year. That's not the point. The point is you're actually building up that discipline, and if you apply that to all sectors of your life where money is involved, that quickly really adds up. And so I think that's really important. But I know we're talking about retirement, so it's a great transition into my next question over here. Doesn't flow so well, but I wanted to talk about this because I don't think many of us are aware exactly how HSA accounts work or why they're so amazing. So many employees or many employers offer an HSA account. Many employees overlook a health savings account, but they offer triple tax benefits. Can you please break this down over here? What is a HSA? Who really should be contributing to this? Is it really awesome or?
Yeah. So I mean, it's definitely a great option to consider when you're looking at your health insurance and which plans to choose. We're in open enrollment season right now, so people are picking their plans for next year. And the HSA, so it stands for Health Savings Account, and what it is normally the way that medical deductions work. And everyone hears, oh, if I have medical expenses, it's a write off. You have my itemized deductions. Well, first off, there's something called standard deduction and itemized deductions. And the standard deduction is what everybody gets, and it changes a little bit every year. But if you're, let's say, married filing joint, you get a little over $28,000 per year deducted against your taxable income. That's the standard deduction. Now you itemize your deductions if the total of your itemized deductions exceed that 28,000 or 14,000 if you're single. And what goes into that is your mortgage interest, your charitable contribution deductions, state and property taxes up to $10,000, and medical expenses. So first off, it's a lot higher than it used to be. A few years ago, they significantly increased it, so a lot fewer people itemize. Pretty much, you have to own a home, and it's got to be at least a $400,000 or $500,000 a year home that you're paying a mortgage on. But within that, even if you itemize, medical expenses are subject to what's called a 10% AGI limit. And so that's adjusted gross income. And so what that means is you don't get $1 of medical deduction until all of your medical expenses have hit at least 10% of your income. So that means if you're earning, let's say, $100,000 a year, your whole household is earning $100,000 a year, you don't get a dime of deductions on your medical expenses until you hit $10,001. And so very few people, and that doesn't count your premiums, by the way, that's just your out-of-pocket expenses.
Oh wow.
And so very few people actually reach that threshold and actually benefit from the medical expense deduction. With an HSA account, so in order to be eligible for that, you have to have what's called a high deductible plan. So it's got to be about, like, I think it's a 4,500 or higher. I don't know the exact numbers, but it's got to be a high deductible plan. And what that does is allows you to open up an account. It's a savings account that you contribute, usually part of your paycheck into, and it's deductible when you contribute it. So whatever money you put into that HSA, you get a tax deduction for. And then when you spend it on qualified medical expenses, it's tax-free. And so instead of waiting until you hit 10%, that $10,000 floor, you get to put money in, and from the very first dollar you spend on medical expenses, those are tax-free dollars. And it's not a use it or lose it. So like the difference between an HSA and an FSA, which is a flex spending account, FSA, you can put that money into a tax-free account, but if you don't spend it by the end of the year, then it just goes away. Whereas an HSA sits like a true savings account, just like IRA or a 401k, and you can invest it in things that are an interest while you're not spending it on on the medical expenses. And so it's a great way to set money aside for medical expenses, but then also earn tax dollars. And then if you end up taking money out of it that is not a medical expense, you just pay tax when you take it out. And
Mm,
so it's a nice way to set aside money. It's not a huge amount that you can set aside, so it's a little over $4,000 if you're an individual, or a little over $8,000 total per year in 2024, at least for your whole family. So it's not a huge amount, but that's about what you get if you're putting money into a traditional IRA
right.
or something like that. Anyway, so it's a nice piece, and you can do both of those things. So it's a nice piece to set aside, and put that money into an HSA to get a little bit of tax free earnings, and then most importantly, spend from your very first dollar getting your medical expenses tax free.
Hmm. You mentioned that for FSA, the money does not roll over to the following year. So my question is, and it's funny because I have a friend who put a couple $1,000s worth on his FSA account. He didn't realize that it didn't roll over, and 2 months before the fiscal year ended, he was just he had to spend it. So
Go buy a cold
where does the money
plunge.
go? Where does the money go? Who gets the money if you
That's a
don't use
great question.
$2,000?
Um, I actually
Black
haven't
hole.
looked into that.
Okay,
But I
I want
think
to know.
it just goes into the plan operators funds. It might
Hmm.
go back into the government's piggy bank. I'm not that would probably, based
So
on how
that's
most
that's
things
insane.
happen, but
So,
I'm
yeah,
not
And
100%
it
sure
makes me
on that.
wonder. That makes me wonder how many employees or what amount gets left over. You have millions of people working. I know for a fact that 100% of them are not utilized or using up all their FSA funds. So I wonder who the beneficiary of all that money is and
Yeah,
what
that's
they're
a
doing
good
with that.
question.
That
and
is not
when
fair.
you
Wow.
mentioned that there is a 10% that you have to spend, and let's say we're taking $100,000 salary. So if there is $10,000 spending, there is no deduction, and if there is $10,000 and one, there is deduction on the whole amount, or if there
No,
is
just a dollar.
just the
Oh,
dollar.
just a dollar.
So it
Okay. Okay.
subtracts the first 10% off of your total.
Okay.
Uh-huh, got
So
it.
it's
Okay.
not great.
No,
That's not.
you got to have a really bad year in terms of medical expenses to really see any
Mm,
benefit from
Right.
that.
Tyler, I want to move on to a little bit another topic here, because I see a lot of businesses would like to put their spouses on payroll for various benefits, and I want to ask: is this a smart move tax wise, and what should business owners know about the specifics about it?
Yeah, great question. And the answer is it can be a smart tax move. And so the typical accountant answer is it depends. Really, there's two kind of key scenarios when it makes sense to put your spouse on payroll. And the scenario it is not, I'll clarify first, because this is what people often ask me. They say, "Hey, Tyler, can I put my spouse on payroll so that that's a deduction to the business?" Well, the answer is yes, but the problem is most people are in an S corporation. Almost all small business owners should be in an S corporation. If they're not, they're probably in a sole proprietorship or something along those lines. But what that means is that it's a pass-through entity, and all of the net income of the business flows through to your personal return. Then you pay tax on your personal return. So if you pay your spouse $30,000 a year, you get a $30,000 wage deduction, but then they pick it up as $30,000 of income on your personal return, and it makes zero difference on your income tax bill. So that's not the reason for paying your spouse or hiring them on the payroll, because you have to pay payroll taxes on those wages, so you end up actually coming out behind. So when it makes sense to get your spouse on the payroll is if you travel a lot for business and your spouse comes along with you, or B, you have a 401k, you have a retirement plan in your business that you want to get additional benefits for by putting them on the payroll. So I'll explain both of those. So number one, if you travel a lot for business and you're bringing along your spouse on those trips, and they're just your spouse, they're not working in the business, then it's just like bringing along, your friend. They're not part of the business. There's no business reason for bringing them along. So that means their flights aren't deductible, their meals aren't deductible, any of that. Whereas instead, if you're bringing along an employee, if you bring employees along on business trips, then that's a full business deduction. So that means the flights are deductible, the meals are deductible. If they're your spouse, you're probably sleeping in the same hotel room, so you don't really have an additional hotel deduction that you're getting. But those can, flights and meals in particular can add up. And so what you want to look at on that side of things is when you do pay, like I mentioned, you have payroll taxes on any wages that you pay them. And so the tax savings from the additional travel expense deductions has to be greater than the cost of the payroll taxes from the wage you're hiring them. So if you hire your spouse for a $50,000 a year salary, you're going to have $7,000 or $8,000 in payroll tax. That's a whole lot of travel expense deduction that you got to make up for. If you
Right.
hire him for a part-time role and pay him $500 a month, then you have less than $1,000 in payroll taxes. Now that's a little easier to justify. Then the other reason would be the maxing out, say, a 401k. You can put, I think, I don't memorize the numbers, but every year it changes, but around $23,000 in 2024 into a 401k. So
Right.
if you pay them a $24,000 salary and then put $23,000 of that into a 401k, now you have your own max that you get to pay and their max. You double the benefits to your 401k that you get. So that would be above and beyond any sort of travel deduction benefit. But those are really the two scenarios when it makes sense to get your
Hmm.
spouse on payroll.
Quick question here. In the case, so what is that minimum threshold look like for putting your spouse or partner on a part-time? Is it $500 a month? So I'm saying, so if we take it one step further and there was an audit, right? It's just like, well, you're paying yourself, you're paying your spouse $5 for the month. That doesn't fly. This is the void. So I'm looking for, can you walk us through a realistic number? Because from what I understand, in order to be compliant, everything needs to be at least, it needs to make sense, right?
It
So what
does. Yeah,
what
it
does that
has to
look
be,
like?
it has to make sense. You have to be able to, if the auditor sits across the table from you and asks you to explain this deduction, you have to be able to explain it to him with a straight face and fully legitimate that this is the business reason for doing this. Because you can't do something just for tax purposes. That is not allowed. It has to be a
Right.
legitimate business reason. So the as far as how much to pay, all that is dependent on what they're doing for you in the business. And so it
Mm,
just has to be the going rate for what they're doing for you in the business. So if they're your assistant on travel, and they just go with you to help, you know, keep your schedule together while you're traveling, what would you pay, maybe a $15 an hour, figure out a flat rate for that and call it $500 per trip or $1,000 per trip. So it's just what is the market rate for what, and it's the same on the low side and the high side. So
mm,
you can't pay someone $24,000 just because it makes sense to max out your 401k. They've got to actually do something for you in the business that's worth $24,000 that you would pay, Joe Blow or Jane off the street, the same amount, right? So
mm.
and then ideally you have an employment agreement set up in place. You pay them a regular salary like any employee would. So that's kind of, it's got to, look and feel like a normal salary for what they're doing for you in the business.
What about kids? If I have kids under age 18,
Yeah.
can I apply the same strategy with them?
So it's actually much better with the kids. As far as the compliance goes, the same rules apply in terms of they've got to be able to do something to justify the wage. But with your kids, because of that standard deduction that I mentioned earlier, a child can earn up to that standard deduction amount. So about $14,000 in 2024, it's going to be 15,000 next year, and pay zero federal income tax. And every state, depending on what state they're in, might have a little bit of state tax, but it's zero federal income tax if they earn less than $14,000 in 2024. And if they're your under 18 children and you pay them from a sole proprietorship, then they are actually exempt from payroll taxes as well, which is about 15% of their wages. So if you're in an S corporation and operating your business as an S corporation, You can open up a small family management company that's a sole proprietorship. Your S corp pays the sole proprietorship, and then the sole proprietorship pays the kids. And that's the difference between doing it the right way and the wrong way, and saving yourself a couple
Mm.
$1,000s a year in payroll taxes per child.
That's it's very interesting. I want to
And
take it one
under
step
18, but
Or
what is the minimum age?
under 18. Yeah. What's the minimum age?
Yeah.
So it's as young as they are, as long as they can do something to justify the salary. So that might mean help sort papers. It might mean if they're in the teen years, help them post some things to social media or looking up what the latest TikTok trend is and consulting you on that. If you have a legitimate online presence and you're posting them to your page a lot, it's part of your personal brand. You can hire them as models and pay for them as models. So it's just got to be something that they do that justifies, just like I mentioned with the spouse situation, that would command a $14,000 salary.
Hmm. And then you can take if you wanted to, would you be able to take that and then take their earned income and put it into a Roth IRA under their name?
That's correct. And now you're setting them up for
Right.
that's the legacy
Right.
stuff right there, which is
So
awesome.
I have a 1-year-old daughter, and I was always thinking about that. But Vlad, like this is a scenario that applies to us because we have an online presence. I mean, and actually, I think Vlad uses his kids every day, at
Every
least
day,
three
right?
times a day on the post of Vlad. There you go, and please set up take that money and set them up with the Roth IRA. Although the real question, Tyler, here is what percent of kids actually will not touch that till they're allowed to at whatever it is 59, 59 and a half. That's what I wonder.
Well, I
It's
mean, you
that
don't have to tell
discipline
them about
again.
it.
That's true.
you
But
know,
but
maybe
that's
when they're
amazing,
married or
like
something. Well, but here's the thing.
That's gonna be a
So
nice surprise, huh?
a nice surprise,
very
don't
nice
wait till they're
surprise.
60 to tell them about it. But if you put money in, let's say you got your 1-year-old and you can legitimately hire them. There's and I can attest to the fact that having a personal brand where you share your kids on it, it builds a know like and trust factor. Like when people
Yep.
come to me on sales calls after following me on Instagram and they say, "Hey, I've seen you out on the boat with your family." Like I love it. It does actually enhance business value. And so that's kind of how I would justify it, if I was in your situation as well. But let's say 1 to 18 power, 7 grand a year adjusted for inflation that you're putting away, a power compound interest, that's going to be worth a pretty penny by the time they
Yeah.
turn 18. In a Roth IRA, you can take that money out as a distribution penalty free to use for a first time home buyer uh,
Mhm.
as a down payment on a home, or for qualified higher education expenses if they're going to college, if they end up going to college. So you have flexibility with that versus like if you just put money into a 529 plan, which is like a tax advantage place to put education funds, they can only use it for higher education. In a Roth, they can use it for all those scenarios, or just save it as a nest egg.
This is why finance gets me so excited because it's all about strategy. There's so many different ways. I mean, it's amazing. It's so much fun, but it really is disappointing that so many of us aren't more into this because, and I get it. Like, listen, there's a lot to take in, but the ways that you can set things up, the ways that you can do and be fully compliant. I mean, it really is mind blowing. It's just really interesting, even to just read about it.
And in your opinion, is there any time when you can consider other better options than Roth IRA? Or
So a Roth is great if you're in kind of in the first, couple $100,000 a year of income. Anything above that, you're limited by how much money you put,
yeah,
or you can't put into a Roth. What you can do is do it's called a backdoor Roth, which is where you put money into a 401k or traditional IRA, and then you convert it over into a Roth, and you pay taxes on the full amount at that time. A good a planning like thing that we do with that is, let's say we someone has a down year, or we start doing tax planning with them for the first time, and we're able to create significantly higher deductions. We bring their income all the way down so they're in a very low tax bracket, and then we roll it over and convert it so they're paying all the taxes at a lower tax bracket. So that can be a way to take advantage of the Roth, with that if you're in that higher threshold. If you are that higher threshold and don't want to bite the bullet on that, usually what we get more into is there's some more complex retirement plans. And I'm not a retirement planning expert, but I know like defined benefit plans, which would be like a pension, is something that gives you a lot more flexibility in terms of putting a couple $100,000 a year away. But with that, it's also expensive if you stop doing it, and so you want to make sure that those higher income plans where you're doing anything above like where the Roth or 401k caps out, and you're going into those higher plans, you want to make sure that you're going to have sustained income because they can be very expensive if you stop having the ability to contribute to them.
Mhm. I have another question. I know a lot of people right now who are listening to us are in real estate, and I have very nice question here. So, real estate investors, they often debate about setting up LLCs for each property versus using one LLC or a holding company. So, what structure do you recommend for someone actively, buying and flipping houses, properties, and what key benefits of each approach?
Yeah. So in terms of LLC for each property versus an LLC, one big company, and you put it all in, that's more of actually a liability, like a legal question than a tax question. Tax wise, doesn't actually matter. It's all passed through, it all comes through. Now, what matters in terms of individual LLC, let's say it does make sense from a liability standpoint to have you're buying old properties in their own LLCs for separation of assets, et cetera. And this is not legal advice. But if you are flipping homes professionally, meaning that's your business, now that income is subject to the profits that you make on each property are subject to you're operating as a sole proprietorship, are subject to what's called self-employment tax, which is 15.3% on the first 170,000 or so of your earnings in your business. And that's basically payroll taxes as a self-employed individual. And so in order to avoid massive amounts of self-employment tax, it's usually better to operate that in an S corporation. And you would and then your flips become inventory. So that goes on your balance sheet. Then when you sell it, it goes to cost of goods sold, just like you would if you were selling t-shirts or cars or any of that, like if you had an
Mhm.
auto deal. So that's if your business is flipping and there's no clearly like explicitly defined level of volume that says you're in the business of flipping versus they're just capital gains. But generally speaking, about 5 flips a year is probably when
Mhm.
you should start looking at moving all of that into an S corporation versus if you're mostly buying long-term rentals and then suddenly one becomes too good of a deal in a market where you got to sell it, then you're going to pay capital gains on that, not business income taxes. So if you're just doing a couple a year and the intention is to buy them and hold them and then a couple you flip, then you don't need to put them all into the one entity. But if you are doing the flipping professionally, then it would be a good idea to consider an S corporation.
But when you're saying couple a year, does it depend on the price of the each property, or it can be, let's say, one property which is a very expensive one?
No, it's really about the intention when you buy it. So if the intention is to buy it as a like an asset that you're holding and then you sell it later, it's just like if you bought shares of any stock, the S&P 500 with the intention to hold it, hope that it grows, and then you sell it and then you pay capital gains on. That's if you buy a rental property and you hold it for 5 years and rent it out that whole time and then sell it, you're not paying business income on that, you're paying capital gain. If the intention is to buy it, turn it around and flip it, now you're doing work on that property with the intention of earning a profit.
Hmm.
Does that make sense?
Mm.
So
Right.
that's really the differentiate. Just like if I buy a bunch of mechanical parts, an engine, some tires, some sheet metal, and assemble that together as a vehicle, and then sell that vehicle for a profit. Now I'm in the business. If I'm just
Mm.
buying, copper that's just sitting there, that hoping that the price of copper is going to appreciate and I'll sell it in a few years, then when I do, that would be a capital gain.
Mm. So for example, right now we bought and we're actually demolishing and building a completely new home. So in that case, would that be in the event that you're actually in the business because you've gone in, you've demolished the existing property, you've now built a property in the event of seeking a profit based on what you put in?
Yeah. That would if it's just a one-off situation,
It's still fine.
then it probably could be fine being capital gains. If it's something that you're doing systematically on a regular basis, then it's
That makes
business.
sense.
And
That makes
and
sense.
and 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 this is where planning becomes critical, because your documentation is everything. So everything's a deduction until you get audited. So
Right,
if when
right,
you're
exactly.
going into the escrow process, if you have some sort of minutes or Word documentation that, you know, look at this deal, here's my spreadsheet of what it'll rent for, what it'll, what I'll get in terms of a cash flow on a buy and hold property, and you've got that documentation that that's the intention, and then you get in there and you look in, and then suddenly it's just totally out of shape where there's no way it's going to rent, and so you've got to do all this stuff to it, and then you're documenting that no, the market's not what we thought it was, so we're just going to sell it. Then that's if you go audit and they try to call that business income, you're like, no, look at my records,
Right,
look at my projections. This was fully intended to be a buy and hold, not
right,
a fix and flip.
right.
So that's where doing some
Makes
of that
sense.
documentation in advance can go a long way in making a better tax situation for you on the back
Mm,
end.
I mean, unless at the end of the project you'll be able to do the 1031 exchange, and also you'll not pay taxes on it.
Right. So a 1031 exchange is when if you have a gain on the property, and instead of just selling it and keeping the cash, you sell it and you roll the proceeds of that gain into a new property. You can do that. I know, I mean, I have a ton of real estate clients and they do those all the time. I have
mm,
seen them screw up where either the 1031 custodian doesn't do things the right way, or here's the other thing that can happen with 1031s is people take a bad deal just to buy it within the window that you have to buy it.
And now the window is
yeah,
very short, right? It's like 30
And
days or something.
yeah, so you have to identify it within 45 days and close within 180.
yeah. It's kind of crazy.
It's pretty
That's
quick.
that's
And
pretty quick.
so for me, a golden rule of like tax planning and really in accounting is that the benefit of doing something has to be greater than the cost of doing it. And so when we're looking
Makes
at,
sense. Yeah.
selling something or, to save taxes or because you've got a gain or rolling it and deferring taxes, if you're deferring taxes into a bad deal that's going to cost
Right.
you more than the taxes that you're saving, then that's a net loss. Just like going and buying $100,000 truck before the end of the year to get a deduction to save 30,000 in taxes. Yes, you save 30,000 in taxes, but you had to spend 100 grand to do
Right.
that. That's sort of like going to the mall on Black Friday and say, "Well, I can't afford not to buy these 14 TVs because they're on sale for 40% off." Well, it still costs you the rest of the amount to go buy that. So, if you need it for the business or it's a good business deal to sell, then do that, but don't just do it for tax purposes.
That's funny. That's a great segue to my next question, actually. So business vehicles come up a lot. So obviously, a business can either lease a car or buy a car. What factors should a business owner consider when deciding between leasing or purchasing a vehicle outright for their business?
So, as far as leasing versus owning, the one factor they should consider is which is a better financial deal for them. And in almost every case, it's buying it when you look at the long term. I mean, if you love turning over a new car every year, then maybe a lease can make sense. But one of the biggest misconceptions that I hear from people is that, well, leasing is better because you can write off the whole lease expense. And while that is true, when you buy it, you still get to write off the whole car expense, the car payment. It's just called depreciation expense instead of lease expense. So it's depreciation
Mm,
expense and interest expense. So when you buy the car, let's say you buy a $60,000 car. If it's over 6,000 pounds, then you can take 100% of the business use percent over through Section 179 in the year you purchase it. If it's less than that, then you have to spread it out over 5 years. If it's an SUV, it's limited to, uh, I think the number is about 28,000 in year one. So there's some limits on SUVs over 6,000 pounds, but you still get to take all of that depreciation.
Huh. I didn't know that.
And so in almost every case, if you can qualify for the loan, buying it's going to be better than leasing it.
That makes sense because right, right. Actually, yeah, it's exactly what you said because you're right. I thought at leasing, okay, it's a full deduction, but I didn't realize even over 5 years, if you depreciate the car that you bought, I mean, it's still being written off just over 5 years, and at the end of the day, it's an asset. It's an asset. It's still worth something as opposed to just
Yeah.
returning your car after 3 years.
Exactly. Or sometimes if you drive all the over mileage penalties that are on those leases, if you instead of
Yeah,
driving at
yeah.
15,000 miles, you drive at 16,000 miles and they're charging you $100 a mile or whatever the rate is, that can
Hmm.
get, and then people just run out of their, they got a year left in their lease and they've hit all the miles and they just have to go park the car for a year.
Yeah,
Yeah.
yeah. Oh, great, great. Vlad, I'll pass it to you.
Okay. Okay. I have another very interesting question here. Donating appreciated assets like stocks or property can offer, of course, tax benefits, but many people are unaware of how it works. So, could you please explain how it works, how this can reduce taxable income, and who should consider this strategy?
Yeah. So when you donate a stock or an asset, basically whatever the fair market value of the asset is what you get to deduct. And so if you've got a car worth $20,000 and you give give the car to an actual qualified charity, then you get to write off that amount just like you would if you dropped everything off at Goodwill. So that can be, if you've got some gains that you're trying to harvest or offset or do it, donating those assets can give you a nice write off without having to shell out a bunch of cash
Hmm.
for it.
So, for example, as you said, you can donate it to Goodwill and then you can write it off. So, let's say I'm buying a property right now and I have a lot of stuff that I can donate to Goodwill. How do I put the value on the things that I donate into the Goodwill? Let's say.
Yeah, so I mean, if it's a bunch of household goods, then just take your best guess. I mean, if you in terms of documentation on that, if it truly is a significant amount, like you're buying a home and you're clearing it out, and it was some hoarder that left a bunch of stuff behind, um, you go into like eBay and
Mhm.
looking at sold histories
Comparables.
Right.
and
Hmm.
seeing what those are going for, and then print out the sold histories and what those are worth. Then that can be a good way to have documentation. If it's clothes and it's just regular clothes, I'd just kind of take your best guess at what, it's not going to be a whole lot, but if it's, per item, but if it's 100 items at $5 an item, then that can, or look at Facebook Marketplace and see what, old ratty clothes are selling for and use that as a guideline. So that's where I'd go on that. And then, if it's like a vehicle you're donating, then you can go to, KVB or any of these websites that value, or you just look at on any of the used car sites and see what they're selling for
Mhm.
and
What's
use that as
the
your
limit
best guess.
of what's the limit of what you can deduct for donating these a-
Yeah,
these assets?
I know cash it's 60% of your income. It's half that for non-cash donations. So like if your income's $100,000 a year, then you can take $30,000 as a non-cash donation. If it's $1 million a year, it can be $300,000.
Wow, that's a lot. That's a
Yeah, I
lot.
mean,
Thirty
it
percent.
definitely adds up. Now, from a documentation standpoint, it used to be that, when you go to Goodwill and you get they ask you on receipt and they give you a little slip and you just hang on to that and you write down household goods or whatever on it. Now they're getting a little stricter on that and they
Okay.
want to see, because everyone has smartphones.
Okay.
And there's a little thing called a camera on there. Best practice on that is when you load it all into the little, loading bay where they accept all the donations, get your little slip, write it what's on it, and then take a picture of the
Hmm.
items so that there's, some evidence of what it is you're donating.
Hmm.
Mhm.
I'm sorry. You were just talking, and something came to my mind right now. I want to ask. You probably may not know the answer, which is totally fine. Also, obviously, we've seen incredible advancements in AI, in LLMs. You have all these image models coming out right now. Well, it's totally unrelated, but what I feel like some of these models, and I might be wrong, but they're getting really sophisticated at creating some incredible things, which took really
Are you
sophisticated,
speaking about
talented
faking
people
the
on
pictures on
Photoshop.
AI?
Yeah, yeah, that's exactly what I'm speaking about. That's an honest question. Are we going to see? What are your thoughts about that? Because listen, there are always good actors, there are always bad actors. These models have made it more accessible.
Yeah.
So, what are your general thoughts on that? I literally was just thinking about that. So,
Yeah, I mean, that's a good question. I think that the when it comes to when it comes to goodwill donations, for as an example, manufacturing a picture like that, those aren't significant donations usually in a single instance. So in that particular scenario, I don't know if someone goes through the work of manufacturing a photo that shows that they've got 18 garbage bags of clothes sitting in a docking
right,
bay, God bless them. I mean, I don't know
right,
that the IRS is going to
right,
really crack down on that. And then on the, donating a $50,000 vehicle, for example, I mean, there's a little more record there
right.
or say, stocks. With stocks, you've got the brokerage houses are all tracking all of the values of those trades and what they bought it for, what they're selling it for, what they're transferring it for. So in terms of like image manufacturing, AI image, it's an interesting question. Um, I would say that, if anything, so for example, let's take meals expenses.
Hmm.
Um, to have a meal hold up, like a business meal, you've got to either be traveling overnight for business and then a meal by yourself is deductible. Or if you're in your local area, you've got to be meeting with someone else and there's a business purpose to the meeting. So whether that's a prospect, vendor, client, etc. And then from a documentation standpoint, you've got to have five things. You've got to have the itemized receipt with the name of the restaurant on it, the date of it, and the amount you spent. Those are all on the receipt. And then the fourth and fifth are the name of the person you met with and the business purpose of the meeting. Well, from a documentation standpoint, it's easiest if you just, when you're checking out and you get in the receipt, scribble those last two things out and then on the receipt and take a picture of it. I could see possibly maybe some sort of like after the fact forging of receipts to have a different itemized deduction as AI gets really sophisticated, instead of just if all you have is a bank statement. But I don't know that we'll see.
I think anyway the AI is developing in this sector, making all these fake pictures. But also, I think all the IRS and government institutions, they will have their security in place. They will
Yeah,
be
AI
checking.
detection. I think they'll have some plenty of
AI detect will its own AI, yeah. So
yeah.
AI will work both ways, basically.
Yeah, I think it will work both ways, and I think people should be fearful for what to come if the government does get their stuff together. If they can actually implement this technology, they can run and feed data through. They can identify all these flags and connect the dots. Because we've been using all these tools for a lot of our work processes, and I mean, I can't tell you. I mean, this is just incredible stuff. The way it streamlines your work. I mean, it's incredible. It's scary also, but it's incredible. Well, we'll see in general, but yeah, Vlad, I'll pass it to you.
Yeah, I have one last question on my side. I know we already talked about the S corp and C corp, so I just want to touch base again on this. Could you please give me, like, who should use the S corp, when you should I use the C corp, and vice versa? What's the taxes implications, liabilities, like, all about that?
Yeah. So really there's three different choices. There's S corp, C corp, and then sole proprietorship or single member LLC, which is taxed the same way. It's just operating as an LLC or just your own social security number. Very few people should use a C corporation. Really, the anyone who's using a C corporation is either getting investor money or they have non-U.S. citizen or U.S. resident owners. Or in very rare exceptions, if they have a lot of medical expenses, There's some really powerful medical benefit plans that you can set up inside C corporations that you can't in S corporations. So very few people, we have less than 1% of our clients are in C corporations, and that's, pretty much across most CPA firms, at least for small businesses. Maybe once you start having profits of a couple $1 million per year, then it starts to maybe make sense to at least run some side by side scenarios. So for most people, the difference is, do I operate as a single member LLC or an S corporation? And I mentioned self employment tax earlier. So that's essentially your portion of payroll tax as a self employed individual. So it used to be if you ever had a W 2 paycheck, going to as an employee, if you look at your pay stub, like we talked about earlier, and the amounts that are withheld from your paycheck, about 7.5% of that is Social Security and Medicare taxes. Then your employer then matches that and sends 15% to Uncle Sam in the form of payroll taxes. And that's what funds those programs. When you're self-employed, there's no one to withhold that 7.5%. There's also no one left to match it. Of course, the IRS still wants their fair share, their 15%. So then you're left holding the bag up from the very first dollar, 15% on top of income tax. It wallops people by surprise the first time they start making actual profit in their business if they didn't do any plans. So the big difference is an S corporation's profits are not subject to that 15% self-employment tax. And yes, it's good to earn Social Security credits and Medicare credits, but once you are at about a $50,000 wage or paying into self-employment tax, no, you basically earn no more benefit into your Social Security after that. That's when you
Mhm.
break even on maximizing your Social Security benefits. So instead of just paying 15% on all the 770,000, you form an S corporation, you pay yourself a small officer salary, take the rest out as a distribution, a dividend. And so now you only pay 15% on that wage portion instead of the full profits. And so the break even on when that makes sense is a net income, a profit, not revenue, but profit of about $60,000 per year.
Mm.
That's when the juice is worth the squeeze in terms of the amount of money that you save if you set it up the right way, breaks even with the extra costs of the extra tax return you have to file. Now you have to give yourself a W 2, so you've got to pay someone to file payroll tax reports and all of that. So at about $60,000 of profit is when you want to go from being a single member LLC to being an LLC taxed as an S corporation.
Mm.
But
And
what about not the single member, but several members LLCs?
so it would be basically double that. So or however many partners there are. So if it's a partners LLC tax is a partnership, the break even is actually a little lower because when your LLC tax is a partnership, you already have to file a separate entity return. So that expense is the same if you're a partnership or an S corporation. If you're a single member, all the business income is reported on your personal tax return. So now you have the extra, um, tax return prep cost to worry about.
Mm.
So it's a little bit lower of a break even on the partnership. It almost makes, I mean, very few. The reason you would choose partnership over S corporation is actually not related to net income levels. Is if with an S corporation, you have to take distributions proportionate to your equity in the business. So if you're 80/20, the person who's 20 has to take 20% of the profits out, and the person who's 80 has to take 80% of whenever you make a distribution. With a partnership, you can set it up where you're 50-50 equity, but one of you gets 30% of the profits and losses, and one of you gets
Mm.
70% of the profits and losses. You're a little more flexible in terms of how you pull the money out as a partnership. Where
Mm.
so if you have someone who wants to be a silent partner, they want to own 50%, but they don't need a dime of money out of the business. They're just waiting for when you sell it. That's when a partnership situation can make sense. If you're uh, in a situation where you always are both taking the money out to live off of and you're fine taking it out proportionate to equity, then an S corp almost always makes sense.
Some very fantastic and very insightful information. Tyler, thank you so much for your time. I have one last question for you, and this is a tradition on our podcast. Traditionally, we ask guests to ask our future guest any question of their choice, but I have a question from you from our previous guest, which is, what is your secret to resilience? What is the one thing that you draw within you that gets you through trials, tribulations, hardship?
That's a great question. For me, at this point in my life, it's my own personal history of stacking wins after pushing through over a period of time.
Hmm.
So what I've noticed is I've had a few different seasons of life where I've had big pops of success. So becoming partners with Tony Robbins, for example, building an audience on Instagram, even down to like running Facebook ads and having a certain amount of time. What I've noticed is, or even putting relationships into like a new area when we move and or joining different business associations after about 2.5 to 3 years of going after it steadily is when the magic starts to happen. And that's my own personal history. And along that way, it's messy, and there's times you want to quit, and there's losses and there's expenses that you're like, why am I doing this? But if you just don't quit, then after that window of time, that it seems to suddenly things click, and if as long as you're not just on autopilot and you're thoughtful about making tweaks and pivots and adjustments. Um, so that's just something for me that I've now at this point have just gritted through it and stuck with it long enough that I know if I just hang on
Yeah.
through the different periods of suck,
Yeah.
eventually it's gonna get me there. And that was just something I had to go with on faith of listening to other people who have been mentors of mine and have pushed through it. And they say, just as long as you don't quit, you'll get there eventually. And, it is true. And now I have my own personal internal history to prove that. And so that's, I'd say, what kind of keeps me resilient through the
Mhm.
inevitable ups and downs.
Very true words. And what is a question that you would like to ask our next guest? It could be anything you want. We don't give any information about who the next guest is. Just kidding.
A question to ask the next guest. I would say, um, what would you consider your most valuable asset that is non-financial related?
Hmm. Awesome question. Tyler, it's been an absolute pleasure getting to speak with you about finances, accounting, and taxes. It's been a wonderful conversation. Can you please let our audience know or share anything that you have going on, projects or social media, what your preferences? Please let us know.
Yeah, so pretty much if you search Tyler McBroom, that on YouTube, Instagram, I post a lot of content on then on TikTok and X, I'm Tyler McBroom DPA. So go follow me there. I put out free tax tips content all the time. It is tax planning season, at least from here till the end of 2024. So if you're interested in getting some tax plans, feel free to shoot me a DM at any of those spots, and happy to set up a conversation with one of our team. But yeah, I'm always giving out free value, tax tips, and all that. So go follow me on all those spots.
Tyler, thank you for the wonderful
Thank you.
conversation.
Thanks for having me.